Welcome to The Explainer. So, as we're wrapping up 2025, the economy is sending some seriously mixed signals. On one hand, the stock market is hitting all-time highs, but on the other, millions of people are feeling this incredible financial pressure. So, what is actually going on? Let's dive in. Okay, so on the surface, things look pretty great for investors, right? The S&P 500 just closed at a record high, over 6,900. But, and this is a big but, at the exact same time, investors are pouring money into silver, a classic safe haven asset. It surged an unbelievable 158% this year. That's the kind of move people make when they're getting nervous. And that right there, that's the central paradox we're seeing in late 2025. This isn't just some weird market quirk. It's a major signal. So what's happening just beneath the surface that's creating all this anxiety, even when things seem to be growing? I mean, on paper, the economy is absolutely roaring. A 4.3% growth rate, that's impressive by any measure. But that big top-line number, it doesn't really tell the whole story. The real question is, how does this so-called growth actually feel for regular people in their day-to-day lives? To really get this disconnect, let's start by looking at how companies are reacting. They're on the front lines of this, and they are definitely seeing consumers pull back on spending. So now they're all scrambling to adapt to this new, more frugal customer. Yeah, the squeeze is real. I mean, you know how it is. When the cost of essentials like rent, childcare, groceries keeps going up, there's just less money left for the fun stuff. And that's forcing a huge shift in our spending habits, away from wants and squarely focused on needs. And this quote from Tubi's chief content officer, it just nails the trend perfectly. We've all felt that subscription fatigue, right? Another price hike, another service to juggle. So people are actively looking for free alternatives. And you better believe companies are noticing. And it's really starting to work. Free ad-supported services like Tubi now make up 2.1% of all time spent streaming. Now, that might not sound like a huge number, but get this. It means more people are watching Tubi than paid services like Peacock or Max. That's a real shift in the power dynamic of entertainment. And this hunt for a good deal isn't just about what you're watching on TV. It's happening with what you're eating, too. Fast food spots and casual restaurants are in this fierce battle, all fighting for customers who are counting every single dollar. Take this, the price of Chili's Big Smasher meal. This isn't just a burger. It's a calculated, strategic move. It's designed to compete directly with fast food combo meals, which, let's be honest, aren't so cheap anymore. It's basically casual dining raising its hand and saying, hey, we can be your value option too. Now, this anxiety that's driving consumer habits, it goes way deeper than just cutting a few subscriptions. For millions and millions of Americans, the single biggest financial weight on their shoulders comes from one place: student debt. Yeah, that's $1.6 trillion. It's a number so massive, it's almost hard to wrap your head around. But for over 42 million Americans, it's a daily reality that shapes almost every financial decision they make. And for years, there's been this myth that student loans are basically a life sentence, that you can't get rid of them, even in bankruptcy. But the latest data shows that this just isn't true anymore. I mean, just look at this shift. It's absolutely dramatic. Thanks to some updated guidelines from the Biden administration, the success rate for getting student debt discharged in bankruptcy has skyrocketed from just 40% back in 2007 all the way up to 87% today. That's a game changer. And this professor, Jason Iliano, really highlights the new reality here. For a growing number of people who are just buried under that compounding interest, bankruptcy isn't seen as a failure or last resort anymore. It's a viable and sometimes the only financial reset button they have. So you take all this immense financial strain, you combine it with the relentless pressure of the modern workplace, and what do you get? A serious impact on our collective mental well-being. And, as you'd probably guess, it's all spilling over into the political arena in a big way. A recent survey found that over half, 55% of all U.S. employees say they're feeling burned out. And we're not just talking about being a little tired. This level of burnout affects everything, from job performance to creativity to just getting through the day. This widespread feeling of struggle has, unsurprisingly, ignited a really fierce debate about wealth inequality. And it's all perfectly captured in this clash over a proposed wealth tax out in California, where Congressman Ro Khanna basically channeled FDR to make his point. So let's just break down the conflict here, nice and neutral. On one side, you have proponents who want a one-time 5% tax on billionaire assets to help pay for a healthcare shortfall. But on the other side, opponents, including Governor Newsom, are pushing back. They argue it targets unrealized gains. That's the value of assets like stocks that haven't been sold yet, and they warn it could drive capital, innovation, and billionaires right out of the state. Okay, so all of this economic pressure, from how we shop to the debt we carry, is forcing a lot of people to rethink one of the most fundamental pieces of the American dream, owning a home. With the cost of a traditional site-built home soaring completely out of reach for so many, manufactured homes are really emerging as a practical, direct response to this huge affordability crisis. And the reason why is pretty simple. Just look at the cost difference. It's stark. A manufactured home costs nearly half as much per square foot to build as a traditional home. And that's before you even factor in the crazy cost of land. We're talking about a savings of almost $80 a square foot. That's huge. And this is not some tiny niche market either. There are over 7 million of these homes in the US, and they provide absolutely crucial affordable housing, especially for lower income households, particularly in rural America. So let's pull it all together. We've traced this whole story from those really confusing signals on Wall Street, and we followed the thread all the way down to the personal financial choices people are being forced to make every single day. It really is all one big chain reaction. And that really is the defining question as we head into 2026. Is this great squeeze just the growing pains of a system that's adapting to brand new pressures? Or are we starting to see the first real cracks before a much larger break? Thanks for watching.